The stock market crash means dividend cuts and falling stock prices. So how do you know which dividend stocks are going to survive? How do you put together a dividend portfolio that will not only keep that cash flow coming, but eventually rebound for those double-digit returns? In this video, I'll show you how to build a monthly dividend portfolio and reveal 8 stocks to put on your radar right now. We're talking monthly dividend stocks today on Let's Talk Money.
Beat debt.
Make money.
Make your money work for you.
Creating the financial future you deserve.
Let's talk money.
Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now Nation, we've been through one of the worst market crashes in more than a decade, and we're still dealing with what could be the worst recession in almost 100 years. Tens of millions of people are unemployed, and it took the market less than a month to lose over a third of its value. That cash flow from dividends has never been more important, whether to help you pay your bills or just to reinvest and take advantage of these lower prices. But with most dividend stocks paying only every 3 months, you're left scrambling for cash those 8 months out of the year. Even with a portfolio of dividend stocks paying in different months, you're still going to be coming up short. So I wanted to put together a portfolio exclusively of monthly dividend stocks, companies with a history of returning cash flow to investors that will produce that dividend payment every single month. Now the problem investors run into looking for those dividend stocks is the vast majority of those monthly payers are either in real estate, business development corporations, or master limited partnerships in that energy sector. If you're just looking for monthly dividend stocks, you're going to be ending up with a portfolio heavily weighted in these 3 areas, and you're going to see it crumble in a market crash. That's why I'm starting our portfolio with 5 monthly dividend ETFs, 5 dividend funds that are going to give you access to a huge mix of stocks, bonds, and other assets. It's through these funds that you'll have that safe cash flow and the returns. Then I'm going to add 3 of my favorite monthly dividend stocks for that upside return. First here is the Global X Super Dividend ETF, ticker DIV, which holds 50 of the highest dividend yielding stocks in the market and pays a 14.4% yield. Now what I love about these dividend stock funds that we'll cover is they invest in quarterly dividend pairs, but manage their cash to produce that monthly dividend to investors. In effect, they're doing the work for you, investing in the very best dividend stocks, but turning the portfolio into a monthly cash machine. Now, the fund investments here are spread across 14 industries, though there is some heavy exposure in a few of these. So we've got a lot of the weight in those MLPs and the mortgage REITs, which haven't done well over the last few months, but could be primed for a rebound. Now, even as those few lagging industries, though, have come down, the fund is diversified enough within these safety sectors like consumer staples and telecom that still produce that dividend. The next fund I'm adding here is the iShares Preferred and Income Securities ETF, ticker PFF, which holds preferred shares of 489 companies and pays a 6.3% dividend yield. I really like preferred shares, especially during this stage of the economy, and it's one of Warren Buffett's favorite strategies as well. Preferred shares are a higher class of stock issued by a company with a guaranteed dividend that pays out before ordinary stockholders. Now these shares are first in line after creditors as well in a liquidation and can be converted into regular shares if the stock price jumps higher. So these preferred shares are safer in or leading into a recession because they have a higher right to assets. And while the dividend can be paused, preferred shareholders are going to get all their back dividends owed before regular stockholders before they get any dividends at all. Now, these are the investments Warren Buffett used when he bailed out the banks in 2009, buying billions in preferred shares in banks like Wells Fargo. Almost half the fund is in banks and diversified financial companies, but a lot of that is just a fact that the financial companies just happen to use these preferred share structure more than other sectors. You also get good exposure here to these other sectors like utilities, real estate, and 6 other industries. Shares of the preferred ETF are down just 14% this year against that 20+ drop in the market, so definitely providing that safety that we need in this crisis. The Wisdom Tree US Small Cap Dividend Fund, ticker DEF, produces a little lower dividend at just 4.5%, but a lot more return upside than those others on the list. This is really a rebound play on top of those dividends. When the economy does snap back, it's going to be these smaller, faster growing companies that are going to provide those double-digit returns. In the meantime, you get that dividend yield that's more than twice the stock market average to wait it out. Now, the Wisdom Tree Fund invests in small cap US companies, so those generally with a market cap under $1.5 billion. It's got a little over half the shares in these top 3 sectors: financials, industrials, and real estate, but no company is more than 1.4% of the portfolio, so I'm not quite as worried about the weightings here. And what I would suggest, and everyone here in the nation has heard me talk about this, is that whenever you're investing in funds and stocks, add up the entire portfolio exposure to each sector. This means going through each fund that you own, adding up how much it has in each of the sectors. So if you have $100 in a fund that holds 25% of its assets in financial companies, and you have another $100 in another fund that holds 10% of its assets in those financials, then you've actually got 17.5%. That's $35 out of the $200 total investment in those financial companies. And why this is important, because you don't want more than maybe 15 or 20% of your total portfolio in any one sector of the economy. There's just too much risk there that if something happens to that sector, like maybe a rock bottom interest rates hit financials, then you don't want it to destroy your entire portfolio. So just make sure you know how much exposure you have to each sector of the economy across all your funds and even your individual stocks. If you find you have more in one particular sector, maybe add another fund or some stocks with assets in those other sectors just to balance it out. Next in our dividend funds is our First Trust Multi-Asset Diversified Income ETF. That's ticker MDIV. And this is really an interesting all-in-one asset class investment. Now, the fund invests evenly across 5 asset classes that typically produce those highest cash flows. These are dividend stocks, REITs, MLPs, preferred shares, and those high-yield bonds. Now, the management fee is a little higher here at 0.7%, but it's still lower than any closed-end fund you'll find, and the dividend yield of 9.5% really makes up for it. As a bonus on this one, the volatility of the fund, so the measure of how risky the shares are, is just 8% compared to 12% on the overall market, the S&P 500 index. That's a result of the 20% invested in preferred shares, which are going to be less risky than stocks and really help to bring that fund volatility down. Now, this next one is one of my favorites right now, the VanEck Vectors Fallen Angel High Yield Bond ETF. That's ticker ANGL. The fund invests in bonds that were issued at an investment grade rating, so a strong financial rating, but have been downgraded into higher yield. Now, this is usually on slightly weakening financials or if the company adds more debt, but 93% of the bonds in this fund are in those first 2 risk ratings, just below investment grade, so still fairly safe investments. Now, what happens is when these fallen angels get downgraded, the price of the bond comes down, but they still pay that coupon, so the interest rate goes up. Now, since these are still solid companies, the default rate is pretty low, and this group of bonds has outperformed the broader high-yield index for 11 of the last 15 years. The fund itself has produced an 8.5% annualized return since 2012, which is really good for a bond fund, and it pays a 6% dividend yield. The expense ratio is just 0.4%, and again, these are bonds of good-sized companies like Sprint and Freeport-McMoRan. Almost 3/4 of the fund is in bonds of U.S. companies, with the rest in developed nations. And it's well diversified across sectors as well, with bonds from companies in 9 different sectors. So with just these 5 funds, you've got an average 8.1% dividend yield, plus some great upside potential on those small cap stocks and the multi-asset fund. In fact, that could be your entire portfolio right there. That safety and diversification, the upside potential, and the 8% plus dividend, with that check coming every single month. But I wanted to add 3 more picks to the portfolio, 3 dividend stocks for higher return potential, but still that monthly payout. First though, I want to show you what I'm looking for in these stocks. Those of you in the community know I'm not just about to drop a list of stock picks in your lap. I want you to know how to look for these stocks, what to watch, so you become a better investor. So here I'm looking for companies with a strong dividend yield, but not at the risk of cash flow problems. You'll see in a lot of high yield stocks, the company is keeping nothing back in cash flow, so that liquidity is a constant threat. Instead, I want companies that are able to keep up that dividend, but also reinvesting in the business for growth. Now, I'm generally going to be looking for larger companies here, ones with a market cap of over $3.5 billion, though I will break this rule on one of these stocks. Basically, I want to make sure the companies have that financial power and the size to survive the recession no matter what. Companies that are going to have that access to credit if they need it. Finally, I'm also going to be digging into the annual 10K report, the annual financial report, to find the schedule for debt maturities. Now here I want to avoid companies with large chunks of debt maturing this year that need to be refinanced or paid off. Most of these companies are large enough and in a good enough financial position that they'd be able to refinance that debt easily, but it's just one less thing they have to worry about. Of course, I'm also looking for companies with a yield of 5% or higher that pay out on a monthly basis. The overall market average is about a 2% yield, so these stocks are paying more than twice the market average. Our first monthly dividend stock is a longtime favorite, Shaw Communications, ticker SJR, a Canadian telecom giant paying a 5.8% yield. Now, Shaw has historically been a wireline business, so that fixed line business, but the acquisition of Wind Mobile in 2016 is really starting to come through with some real growth and making wireless the company's biggest profit center. The company is investing in its network improvements with deployment of a 700 and a 600 megahertz spectrum, which it acquired in recent auctions, and really becoming a player in that wireless market. Now, Shaw has $130 million on the balance sheet, with balance sheet cash with no debt maturities until 2023. So definitely the financial strength that we're looking for here, and the business isn't something that's going to take a hit from these shelter-in-place environments. So first and second quarter earnings might actually be pretty decent with this one. We've got price targets from 7 analysts here, with targets from $16.90 on the low end, right around where it's trading at now, to 38% higher at $22.53 per share over the next year. So a great dividend plus that upside price potential. I'm breaking my market cap rule here with $300 million Gladstone Investment Corporation, ticker GAIN, and its 9.6% dividend yield. Gladstone is a business development corporation, a BDC, for what's called middle market companies. These are U.S. companies with earnings in the range of $3 to $20 million a year. So not quite big enough to list on the markets, but still big enough to need more credit and funding that can be provided by your traditional community bank. Now, basically, BDCs like Gladstone are a mix of an investment bank and a venture capital firm because they provide both that debt funding and the equity investment into a company. And why I like GAIN here is because it takes a higher equity share than most other BDCs. Gladstone targets investments of 25% equity and 75% debt versus a traditional BDC that's usually going to take less than 10% equity in the companies it works for. Now, that higher equity ownership might mean higher risk, but it's also going to mean higher returns on these investments. And we see that in GAIN's history of return on equity, which is well above the industry average. The 5-year average return on equity, that ROE, is 17%. It's over 3 times the median ROE for the BDC group. And even though near-term return has come down, it's still well above the average for that group. Gladstone's current portfolio is spread across 28 companies in 14 industries, so a level of diversification there that should help it continue those returns even in the sluggish economy. Our third monthly dividend stock is Stag Industrial, ticker STAG, a real estate investment trust with a 6% yield in one of my favorite property types. Stag owns 450 buildings in 38 states and 91 million rentable square feet, and it's in that industrial warehouse space. Nation, the rise of e-commerce and online shopping has just destroyed the retail property market. But all those online orders, they need to be stored somewhere, and that's meant a boom in warehouse demand. In fact, 43% of the Stag's property portfolio is involved in e-commerce activity. Now, no tenant accounts for more than 2% of the company's total rent revenue, so the odds of a tenant failure vacating lots of space is pretty much zero. Shares trade for just 13 times funds from operations, so a solid value play here, and the company only has $300 million in debt maturities this year and next. We've got price targets from 4 analysts here, with estimates from $24 a share at the low end to as high as $35 a share over the next year. Check out the video on the right for my 5 favorite stocks for triple-digit returns. 5 stocks with an average price return of 80% and higher. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.